Hi, my name is Jerry Yu, the Family Money Doctor, and thank you for joining us today. I have been helping clients with retirement planning for over 20 years. The reason I wanted to record this video is to clarify one of the most misunderstood investment principles. And I am going to use math to prove to you the common myth about market fluctuation. So before we go into today's topic, it will be awesome if you can click the subscribe button. It will help me tremendously. When I first got my corporate job after college, the HR asked me to fill out a 401k form. I didn't know what 401k is, let alone choosing an investment option. So I turned to the guy next to my cubicle for help. And he told me his method is to pick the highest average return fund to set up his 401k plan. Does that sound familiar? See, I'm going to use math to prove to you in retirement planning, average return really doesn't mean a whole lot. Let's look at this slide. See, for example, if you have $100 and this year you earn 50% return, but lose 50% the following year, how much money do you have? A lot of people will say to me, well, if I gain 50% and lose 50%, I'm going back to the original amount of $100. But is that true? Let's do the math. The math does not lie. The first year you earn 50% of your $100 investment. So at the end of the year, you should have $150. Now the following year, your $150 lose 50%, you end up with $75. Wait, hold up, Jerry. Are you telling me my investment goes up 50%, then down 50%? I lost $25? Yes. See, let's try a different scenario. You invest $100 in the market, but the first year the market goes down 50%. You end up with $50. The following year, your $50 earned 50%, you end up with $75. So regardless, you earn 50% first and lose 50%, or lose 50% first and earn 50%, although the average return is zero, but in reality, you lost $25. But the most important thing I wanted to make you aware is that when you lose 50% with ending balance of $50, in order to get back to the original $100, your $50 need to double. Your $50 need to earn 100% return just to have the $100 back in your account. See, let's apply the rule of 72 for calculation. If you can earn 7.2% every year, it will take you approximately 10 years to get back the original $100. How many 10 years do you have in your lifetime? What if the market crashes 2 years before you set to retire? How will that impact your retirement plan? One of Warren Buffett's most famous sayings on investment is, rule number 1, never lose money. And rule number 2, never forget rule number 1. So remember, when you're planning for retirement, average return doesn't mean anything. The key takeaway from today's video is never lose money. But what can we do to make sure we don't lose money? Then you will need to contact us or your financial advisor, asking him about the 0% floor guaranteed investment options. See, I hope today's video will clarify one of the misunderstood concepts. And if you like this video, please make sure to hit the subscribe button and share this video with your friends and family. And I will see you again in the future video. Thank you.